Hi everyone. So today I wanted to go through the temporal problem that I did last time in the financial statement translation part 2 video. However, today we're going to use the temporal method. So we're going to use the harder of the two translation methods. So let's do a little bit of a recap. So we have the local currency, we have the functional currency, and we have the presentation currency. Last time what we did is we went from functional to presentation. So then we're using the current rate method. This time we're going from local to functional. So what we have to do is we have to use something called the temporal method. So these are your two methods of translation. Now, if you remember, current rate method is the easier method because your assets and liabilities are recorded at the year-end rate, and then all of your equity is recorded at the historical rate. And so you're going to have a difference when you translate your statements because you translated your equity versus your assets and liabilities at a different rate. So your difference is going to be your translation gain or loss, which sits in OCI. All right. And may I remind you that in OCI, the translation gain or loss is cumulative because OCI is a reoccurring account. Every year the account carries forward, right? And then we have the temporal method, which is what I want to take a closer look at today. So here your assets and liabilities are recorded, well, the monetary assets and liabilities are recorded at the year-end rate. And then your non-monetary assets and liabilities are recorded at the historical rate. And your equity, as always, stays at the historical rate. So this time you're going to have an imbalance again when you translate the statements, and your translation gain or loss is going to go to net income. This is the major difference. Your translation gain or loss under temporal method sits in net income. So I want to take a closer look at it, and that's it. So the problem I'm doing is a temporal problem. I'll post the Excel solution to it so that you can have it. And let's just go ahead and do the problem and see how it goes. So I want to start by doing the same setup. So I'm going to do the first year. The problem has 2014-15. You can do 2015. I'll start by showing you how to do 2014. So 2014, I set up my paper. I go local, then the rate, and then the functional currency. If you were doing functional, then you do functional rate going to presentation currency. The setup is always the same. Now, if you remember in the current rate method, when we built our income statement very quickly, if I can show you, under the current rate method, we would just do income before tax. We do less income tax expense, and then we'd get our net income. What we cannot do in temporal method is we cannot do this. We can't just take our income before tax for the value. We can't just pull it from the question. If they give it to you in the question, you can only do it when you're using current rate method. And I'll show you at the end. I'll come back and it'll make more sense. I'll explain to you why, but you really have to go line by line, and you really have to break down where your income is coming from. So your revenues this year, we start with gross revenues or gross sales, which are 300,000. Then you would do your revenues minus your COGS. And your COGS, in fact, are made up of the famous formula that we know, which is your beginning inventory plus your purchases minus your ending is your COGS. So to make the question easier, I know from the question that my ending inventory is 240,000. And at the beginning of the year, the company started operations. So it had no inventory. So it purchased 240 during the year, and COGS is nil. Okay. And I gave it to you. I purposely made it so that COGS was nil so that it was easier for us to approach the question. Okay, so let's leave COGS here for a second. And then I have depreciation. So my depreciation is, how much is my depreciation? My depreciation is 165. So less my depreciation. And then I should have my net income. Oh, and I forgot. Well, actually, I'll just make it all in one line. So then I'll do my income before tax, my income tax expense. So I have income tax expense of 60,000. And then I can come to my net income amount. Now, let's go to revenues. Revenues were incurred evenly throughout the year. So I'm going to take it at the average rate for the year, which is 1.02. Then my COGS, I'm going to tell you that my purchases were incurred evenly throughout the year. So let me go and break down COGS for you. And let me go and explain this. So for our COGS, let's say, and this time it's really easy because our COGS is nil and all the purchases were made evenly throughout the year. But if we take a look or a closer look at our cost of goods sold, we have beginning inventory plus our purchases minus our ending inventory comes to our COGS. In our case, we had nothing in beginning inventory. We had 240,000 of purchases and ending inventory is 240, so COGS is nil. Translated, what would this be? We incurred or we purchased the inventory throughout the year. So I'm taking the average rate for the year, right? So whatever this comes up to, I think this comes up to 240 times 1.02. This is 244,800. So this would be my translated purchases and my ending inventory. Well, what rate is my ending inventory at? It's at the rate that I purchased it. And we assume FIFO, unless they tell us otherwise, but we assume first in, first out. So everything in ending inventory is at this rate because it was all purchased during the year. Okay. What if you went into the next year? Because here, as easy as it is, we need a couple more numbers to understand really how the COGS works. So what if we went into the next year? So next year, my beginning inventory is 240, right? At 1.02 because it was purchased last year at this rate. Inventory is a non-monetary item, so you have to keep it at the historical rate, right? Then let's say I made purchases of 10,000. I made those throughout the year of 2015, okay? And I forget what my average rate for 2015 is, but I'll just put a question mark. Whatever my average rate is, or let me just make it up. My average rate for 2015 is, let's say, 1.03. Then my ending inventory, let's say my ending inventory is 30,000. Whenever I'm valuing my ending inventory and whenever I'm trying to figure out my COGS, this ending inventory is made up of 20,000 of inventory at 1.02 and 10,000 of inventory at 1.03. So that's what I'm trying to stress to you, that in order for you to get your translated cost of goods sold, or in order for you to have the proper rates, remember, first of all, you're using FIFO, and always remember to value your ending inventory as if FIFO. Remember, 10,000 comes from your latest purchases and the other 20 comes from whatever was in beginning inventory at their respective rates of when they were purchased, okay? Because our example is, I overly simplified it, but that's what's important for you to know whenever you have inventory moving or beginning inventory involved. This is how you need to approach it. So that was a sidebar, but to go back to here, our COGS is nothing, okay? Our COGS is nil. And if we had to translate it, we would do it at 1.02 because we purchased it evenly throughout the year. So it would come up to 244,800. And then we have ending inventory of 244,800. So our COGS, in fact, is nil. Okay, our translated revenues are 306,000. Our depreciation is the same as inventory. Depreciation is related. You have to go back and say, okay, this depreciation, what is it related to? And it's very simple in this example because you only have one thing that's depreciable, and it's the plant. Now, when did you purchase this plant? Plant is a non-monetary item, so you have to use the historical rate because for everything that's non-monetary, we use the historical rate. We purchased the plant at the beginning of the year. So at the beginning of 2014, the rate was 1.05, and that's what you would use. if your depreciation for the year consisted of multiple depreciation. What I mean by multiple is the depreciation comes from several assets. You need to break down your depreciation. You can't just take the depreciation and multiply it by a single rate. You have to break it down based on the historical rate for when every asset was purchased, okay? It's just a little bit more tedious, but that's what you have to do. And then our income tax, because our revenues were incurred evenly throughout the year, we assume that the income tax was, well, we were taxed on the income evenly throughout the year. So that's our logic for using the average rate. So if I convert my depreciation, it comes up to 173,250, and my income tax comes up to 61,200. So now my translated net income will come up to 306,000 minus 0 of COGS, minus 173,250 of depreciation, and 61,200 of income tax. That brings me to net income of 71,550. All right, so now let's go build our balance sheet. I want to come back here at the end and kind of finish the question off, but let's go to the balance sheet. So on our balance sheet for 2014, and we set it up the same way as we did for the current rate method. So I have all of my assets. So I've got cash, and I'm just copying. I've got inventory, I've got my financial assets, I've got PP&E less accumulated depreciation, and I've got land. Then I have, and I could do my total assets. Then I've got for liabilities, I've got other current liabilities. I've got my dividends payable. I've got my bonds payable. And that'll give me my total liabilities. And you know me, I like to do a line that's net assets, which is essentially my assets minus liabilities. So my cash, so the same way, my setup is the same. I'm going from my local currency, this is my rate, and this is my functional currency, right? So my cash is 15,000, inventory is 240, financial instruments is 322,500, PP&E is 318, accumulated depreciation is 165, land is 97,500. My other current liabilities is 60, bonds is 60,000, and dividends is 600. Now, when I'm doing this, I like to mark down right next to the asset or liability whether or not it's monetary or non-monetary. So cash is monetary, and financial instruments is monetary, and all of my liabilities are monetary. Now, for those of you who are wondering what is monetary, non-monetary, the video that I posted on financial statements translation part 1 towards the end of the video takes you through what is monetary and what is non-monetary. Okay, so have a look at that video. So everything that's monetary, the rule is you translate it at the year-end rate. So the year-end rate is 1.09, 1.09, and this is all 1.09. Then everything that's non-monetary, you translate at the historical rate. So this means the rate that it was originally purchased at. So all the inventory was purchased this year, and it was purchased evenly throughout the year. So the average rate for the year. PP&E was purchased at the beginning of the year, so that's 1.05, and the depreciation along with the PP&E is 1.05, and the land as well at the beginning of the year. Now let me reiterate, the same thing for inventory, for land. If you have a group, let's say right now you only have one piece of PP&E, so you only have one rate to worry about. If you had multiple assets sitting in property, plant, and equipment, and you purchase them at different points through time, you need to keep track of when they were purchased. And then you almost need to build a schedule on the side. You need to build like a PP&E schedule and translate the ending value for every asset at its historical rate and get your final translated amount, okay? So now I'm just going to translate everything. So my cash is 16,350. My inventory is 244,800. My financial instruments are 351. 525. My PP&E is 333,900. The depreciation with it is 173,250, and the land is 102,375 for a total of 875,700 of assets. My liabilities is at 65,400. This is 65,40 and 65,400 down here for a total of 137 and 340. And my net assets, so my assets minus my liabilities, should come up to 738 and 360. And now the hardest section, which is my equity section. So equity, our favorite section. So equity has share capital. Then it has retained earnings, which consist of beginning retained earnings plus net income minus any dividends equals ending retained earnings. And then we have our COCI. And then we have, just let me leave it at that. And our COCI is the same. It's our beginning plus our OCI income for the year equals our ending OCI. So for the equity, I hope you can see this. Okay, so for the equity, our share capital is 495,000, and I will translate it at the historical rate, right? I started the company this year and I issued all of the shares at the beginning of this year. So it'll be 519,750. Then my COCI, let's skip retained earnings. I'll come back to it in a second. My COCI, I had nothing at the beginning of the year and I earned 138,000 of OCI income this year. And that means my ending OCI is 138. My OCI was earned evenly through the year. They tell me that in the question. So my translated OCI is 140,600. 147.60. Okay, so let's go to the most complicated section, which is the retained earnings. Now, because we're using the temporal method, your translation gain or loss is going to sit within your net income, right? So in order for us to get the translation gain or loss, let's go step by step, okay? Okay, so there's a couple sections to this. So we know our beginning retained earnings is nil because we started the company and there's nothing in retained earnings. And our dividends is 6,000, right? Now, if we come over here, our translated dividends will be 65.40. That's awful handwriting. Our translated dividends will be 65.40 and our beginning retained earnings will be nothing. Now, what I want you to leave empty is these two sections, your ending retained earnings and your net income. That is what our plug is going to be. That is what's going to help us figure out what is our ending retained earnings. So how do we do that? First of all, I said that wrong. We want to leave our ending retained earnings empty and we want to leave our net income section empty. Why? First, I want to figure out what is my ending retained earnings. That'll be my first plug and that will then help me figure out what is my net income. Okay, that is my second plug. And then the last step is we're going to figure out our last plug. What is the translation gain or loss? So let's do it on the side. So we know that our equity section has to equal to our assets minus our liabilities, which is this. It's 738,360. So our equity should come up to 738,360. And we already have share capital in equity of 519,750. And we already have COCI of 140,760. And this is where I got the numbers from, right? I already have share capital and I already know what the translated OCI is. All I'm missing is my translated retained earnings. So if I do what my total equity should be minus share capital minus COCI, it should give me a total of 77,850. So this is what my retained earnings will be, okay? This is what my ending retained earnings should come up to. Now, if this is what my ending retained earnings comes up to, then I want to know, okay, what is the breakdown for my retained earnings? So we had beginning retained earnings, we had plus net income minus dividends equals our ending retained earnings. So we had dividends of 6,000 and we had beginning retained earnings of nil. And translated at the year-end rate, our dividends are 65.40. So I know that my ending retained earnings is 77,850, right? My beginning retained earnings is nil. So that must mean that my net income is the plug. My net income is the difference. So if I had to do 77,850 plus 65.40, that will give me my total net income of 84,390. Within this net income sits my translation gain or loss. So now I'm going to find my translation gain or loss, which is the last thing I need to find. So if I wanted to break down my net income, it would be made up of net income and my translation gain loss. So my total net income comes up to this. It comes up to 84,390. Now, this is why at the beginning I had broken down the income that we had. So if I come over here, my income broken down is 71,550. That's my income broken down. My translation on it is now the difference. So my translation on it will be 84,390 minus 71,550, which is 12,840. All right, so we went in a loop. So let me go back and try and explain the loop that we went in, okay, in case you got lost somewhere. So your first step is you want to build the income statement. We did that. Then build your balance sheet and come find the plug for ending retained earnings. That's your first plug, okay? How do you do that? Your equity, your total equity, which means your share capital plus your ending retained earnings plus your COCI, those three things together should come up to assets minus liabilities, right? So you have your total assets minus liabilities less the share capital less the COCI, correct? That will give you your plug for ending retained earnings. So I have now found my plug for ending retained earnings. Now that I find the plug for ending retained earnings, I then find my plug for net income. Why am I plugging net income? If you're wondering, because you're saying, Krishna, you already have net income. It's over here, right? We calculated it in our income statement. No, right? Your net income includes your translation gain or loss. This is what I was trying to stress at the beginning. When you use temporal method, your gain or loss sits in income. It's combined and it's one. It's essentially your income contains regular income and it contains your translation gain loss. So that's what this 84,390 represents. It's my second plug that I found, right? And all I did is just math. I plugged my amount for ending retained earnings, my first plug. I knew what my translated dividends were, and I just worked backwards. I just did this plus this should equal my net income. Now my last plug is my translation gain or loss. My net income, like I told you, is made up of two things, income and translation gain loss. So here it is. If my total income is 84,390, my net income that I had initially translated, right? Initially, just only net income on its own is 71,550 from my income statement, which is the first thing we did when we started this question. So the difference must be my final plug, which is translation gain or loss. And this is why I want to come back and tell you, this is why we break down income. Under current rate method, it's a lot easier. You can take income before tax less income tax equals your net income. When you're doing the temporal method, you have to be a little bit more careful. It's a bit more tedious. You really have to go, okay, gross revenues, less COGS, less depreciation, less any other expenses you had, and then less income tax expense. Each of them at their individual rates, okay? And the reason why we do this is because at the end of the day, it's the temporal method. The gain or loss lies within income. That's your answer. That's your reason for why we do this. The translation gain or loss sits in income, in net income, which is why you need to translate every single thing at its rate, at its respective rate. Okay? So we have all of that. Now, the last thing I want to do, so this is your translation gain or loss plug. Okay? You can come back over here and you can finish your ending retained earnings. So your net income here would be 84, what was it? I think it was 84,390. Your ending retained earnings, we had solved it. It was 77,850. So you can come back here and finish up your statement, and you can go over here and finish your net income statement, right? It'll be translation gain or loss of 12,840, which will come up to your total income or total net income of 84,390. All right. So last thing that you have to do, perhaps the hardest part, is the proof. While you can plug the number, you need to know how to do the proof for your plug, right? Your translation gain or loss. So when we did it under current rate method, we were saying, what is our change in net assets under the current rate method? In the temporal method, what we have to do is we have to say, what is our change in monetary net assets? Now, I'm throwing around words and you might be confused, but think about it. Under temporal method, assets minus liabilities, equity. All of your assets and liabilities, monetary is at the year-end rate and non-monetary is at the historical rate. Your equity, everything is at the historical rate. The item that is causing the distortion in your translation, that's causing your statements to be off when you translate them, is everything monetary. That's what's causing your statements to be off, because they're the ones, the monetary items on your balance sheet are what items are translated at the year-end rate. Everything else stays at historical rate under temporal method. So that's the logic behind why we want to look at the change in monetary assets. So we kind of start the same way as we did in the previous one when we did current rate method. I'm going to start with my beginning monetary net assets. All right. And this right now, I will just tell you it's share capital. I will come back and I will explain why it's just share capital. Okay. But anyhow, let me come back and explain it. It'll make more sense that way. So I'm going from my local currency, I have my rate, and then I'm going to my functional currency. Okay, so what you want to look at is it's almost like a cash flow statement. You want to look at everything that affected everything that affected cash this year. Where did you use cash? And here are the common categories. If you purchased inventory, you used cash. If you made sales, all of the money you collected from gross sales, that's cash. If you paid dividends this year, that's cash going out. If you purchased property, plant, equipment, if you purchased intangible assets, all of that, if you purchased land, all of that is outflow of cash, okay? Things like that. So to reiterate, making sales, purchasing inventory, paying out dividends, paying out income tax, all right? Buying property, plant, and equipment, buying land, selling property, plant, and equipment, selling land. All of these are inflows and outflows of cash. So it's essentially a cash flow statement, but a lot more simplified, okay? That I know that doesn't give you reassurance, but it's a lot more simplified. So beginning monetary net assets, then you're going to have all of your increases in revenue, or all of your increases in cash. Sorry, not revenue, cash. So I made revenues this year, so that's going to increase my cash. All right. What else did I do this year? I made OCI income this year, so that's going to increase my cash. What's going to make my cash decrease is my purchases. So I made purchases because I purchased my inventory this year. Then I paid out dividends this year. Then I bought property, plant, and equipment, and I bought my land at the beginning of the year, and I paid out income tax. So those are going to be all of my decreases this year. And that should bring me to my ending monetary net assets. Now, Revenues I made, so now I just plug in the numbers. Revenue 300,000, OCI 138. My purchases of inventory were 240. My dividends were 6,000. My PP&E that I purchased was 318. My land was 97,500, and my income tax expense was 60,000. All right, and that should give me a total of 211 and 500. Now, the reason why I right away told you that your beginning monetary assets is only your share capital is this, because you started the company this year, so you didn't have anything to work with. But if you ever wanted to check your beginning or your ending monetary net assets to see if you had the amount right, what you essentially want to do is you just want to add up all of your monetary assets and liabilities. So everything that I have monetary at the end of 2014, at year end 2014, all of my monetary assets and liabilities are cash, my financial assets, I've got my bonds, my dividends payable, and I've got my other current liabilities, right? So my cash is 15,000. My financial instruments is 332,500. My bonds are 60,000. My dividend is 6,000, and my other current liabilities are 60,000. If I take the sum of this, it'll be the same. Do you see? There's my check. Okay. This year, whenever you start a company, your beginning monetary net assets, because you have nothing in the company, is share capital. Okay. By default, that's what it will be. And that's what you use if you started the company in the current year. Next year, if you wanted to check your beginning monetary net assets, it would be 211,500. What you would essentially do is for your beginning monetary net assets of the following year of 2015, you would essentially add up everything from 2014 year end, all the monetary assets and liabilities. Okay. So that's how you figure out beginning, ending monetary net assets. Now, similar to what we did in current rate method, you just translate everything at its respective rate, at its historical rate. So beginning share capital was at the beginning rate of the year, 1.05. Revenues are incurred evenly throughout the year, 1.02. Same thing with OCI, 1.02, incurred evenly throughout the year. Purchases, same thing, evenly throughout the year. And income tax expense, evenly throughout the year. Dividends are at the year-end rate, 1.09. PP&E is at the beginning of the year, 1.05. And land I bought at the beginning of the year, 1.05. So if I translate this, I'll have 519,750. I'll have 306,000. I'll have 147,60. My purchases will be 244,800. My dividends will be 65,40. My PP&E will be 333,900. My land will be 102,375, and my income tax expense will be 61,200, which will give me translated ending monetary net assets of 217,695. What you want to do now is you want to compare it to the year-end rate. What are my ending monetary net assets translated at their respective rates compared to what would my monetary ending net assets be had I translated them at the year-end rate? At the year-end rate, my monetary net assets would be 230,535 had I translated them at the year-end rate, but I didn't. I took them at their respective historical rates. This is giving me a difference, and my difference will be 12,840. There you go. That is your plug. You just solved for your plug. And that's exactly, if this agrees to what you have when you solved it as a plug, if your proof agrees, then you did everything perfectly. If you didn't, well, then you have to go back and figure out where you went wrong. But that's essentially your proof, okay? So to summarize the question, we did, in part 2, the video part 2, I did current rate method. Today in part 3, I did the temporal method. So I started off with my income statement. I built my income statement. I broke it down with the individual rates for revenues, COGS, depreciation, income tax. Then I built my balance sheet and my equity section. I solved for my plug, which was net income. So how I did it is first I solved for retained earnings, then I solved for net income, and then I solved for translation gain or loss. And then finally, I came and I did my proof. This is my proof. This is my proof, and I did my change in monetary net assets to see if my translation gain or loss plug was actually what I had solved for, to make sure that I was right. So that is how you do the temporal method.